I take it as a great compliment that people take time out of their day to listen to what I have to say. As always, with these webinars, if you have any comments or questions or anything you'd like to add, please type it into the chat. I believe I'll be able to see it. There seems to be something different about the chat this morning. There's also a Q&A position which seems to be disabled, so don't do that. Let me see what else I have here. Nope, no recent apps. Okay. I should be able to see your questions. I certainly hope so, so please type them in if you will. Today's topic is, apropos of my column last week on our website, a little bit of self-promotion here, and also up on Real Clear Markets. What has the credit market's attention? Well, I think we all know the answer to that. I think someday, just in general, it might be nice to not be so rigidly fixated on what the Fed is going to do. I mean, there is a real world out there which has apparently a lot less to do with the Fed than the Fed would like to think. But we are back once again discussing, and until actually Friday, essentially, or you could, until Friday, the credit markets were pretty good at ignoring what the Fed had claimed it was up to. Now, what you're looking at in the chart is, of course, the Fed funds rate over the past 20 years and US GDP. Remember, the ostensible purpose of Fed policy is to promote growth. They don't put it that way. They say it's to promote full employment and stable inflation, leaving the definitions of both to the people who are doing the actions as well. And what we can see is that whatever else can be said about Fed policy since the financial crisis, the only way to claim that it has improved is counterfactual, in that it would have been worse. It's an argument you can make. It's an argument the Fed has made many times, although I don't think they're very comfortable making it, because as they are statisticians and supposed and economists, which is, so they claim anyway, a branch of science, making a counterfactual argument is the weakest type of argument you can possibly make for a policy. But looking at this chart, we can see that the theoretical claim that demand side support produces economic growth is dubious. The chart that we're seeing here for the past 7 years, as far as the degree of growth, the rate of growth, looks very different, very little different than the years before, the 10 years before. So if that's true, then certainly, and that is true, that's empirical. You know, there are a couple of ways science is supposed to work in that you observe something, you don't understand it, a phenomenon. You come up with a theory, an intellectual, usually mathematical representation of what you're observing in the world. And then you test it. You test it against empirical observations going forward. So if you have, in this case, the classical Keynesian theory that the problem with downturns is lack of demand, then you use the tools at your disposal to promote demand. Now, there are two things here. There can be one problem in the theory that maybe that's not the case. And two, it could be that, in other words, that the cause of a downturn is not lack of demand. Or two, it could be that that could remain true, but your tool or tools for promoting demand are inadequate. Just from the observation here, there's nothing that tells us whether it's an erroneous or faulty theory, meaning it's not nearly as descriptive as we think, or in fact, the tools are not very good, because the Keynesians would probably say interest rates are an inadequate tool for this type of demand stimulation, and you need fiscal tools. Be that as it may, I can't answer that argument. And certainly we can look at this chart from the very beginning. This is behind the Fed's mandates, of course, and see that whatever is supposed to happen certainly hasn't happened. Again, back to what I said earlier. The only real defense for this is counterfactual. And I'm telling you, anyone who deals in mathematics or any branch of analysis which pretends to be a science or at least rigorous, and their only argument for what they're doing is a counterfactual argument, they need to address their assumptions. Because a counterfactual argument is not proof of really anything. Okay, so let's move on. So far, I'll just say I haven't seen any chat, so I hope that it comes over the chat that I have up here. As I said, Google Hangout seems to have changed in the month since I did a webinar. I was on vacation for a couple of weeks. Very enjoyable. Okay, so dumped it on. By the Fed standards. Non-farm payrolls. Okay. What we have seen, and today is what, the 12th, so it's 3 weeks, more or less, from, a little bit less actually, from the equity peak and also the peak in rates and 10-year and 2-year. What had happened at the 26th, and before that as well, the basic policy moves we've seen have been, of course, chatter. The Fed, both in the person of Janet Yellen and various other Fed officials, Stanley Fischer, Eric Rosengarten, pronounced that name correctly, from the Boston Fed last week, have been determinedly talking up September. The 21st, 9 days, live meeting, you'll pardon my vulgar expression, or at least my colloquial expression, yada, yada, yada. How many times the past 3 or 4 years have they done this? And how many times have they actually fulfilled? The Fed's record, at least over the past year and really long before that, is dismal as far as both predicting where the economy is going to go and what their own actions are going to be. Again, this is empirical observation. Back in December, we all know the Fed said they were going to consider, their projections, which of course were not projections. I don't know what they thought the market would think they were. Tarot cards for rate increase as well. We can see what happened with that. It didn't work. Just a projection of a rate cycle of that dimension, which is small, produced an enormous equity tantrum in January and February. We then had this dip right here in non-farm payrolls, one of the Fed's signature, like Frank Sinatra's signature color was orange. The Fed's signature statistics are non-farm payrolls, the unemployment rate, and core PCE, personal consumption expenditure price index. So instead of actually raising rates, as I said they were going to, they were short-circuited by the global stock collapse in January and February. I would say something on the order of the Chinese devaluation of the yuan as well. And then we had non-farm payrolls, and here we are. So the Fed is once again actively talking up rate increases. I'm going to write a column this week I'm pretty sure that the title will be, what is the price of credibility for the Fed? What is the price for Fed credibility? There isn't really any, by the Fed's own standards, concrete reason, economic reason, in current statistics to raise rates. Now, there are reasons for doing it, which I'll get to. And that's, I think, what the Fed is getting at. But as far as economic reasons, there is nothing in this chart which shows accelerating job creation, the kind of job creation that pressures wages because employers have to offer more to get workers, leading, of course, to inflationary. Okay, let's look at another sign of that. There's personal income. Okay, this is the longest chart I could find. The reason I don't use average hourly earnings or average weekly earnings, which come out with the non-farm payrolls report, is because they don't go back far enough. I wanted a historical. So this is U.S. personal income annual changes year over year. If the economic argument for Fed, and one more, let me just backtrack. So we've gotten three, and the stock market, of course, crashed on Friday, 400 points, because they apparently started listening. And also the credit markets have started to listen. The rates have gone up. I think the 10-year's gone up about 15 points. Recently it had dipped after Janet Yellen's speech on the 26th at the Jackson Hole, Wyoming Fed conference. They do it every year. They'll get out there. It's lovely up there in the mountains. You notice they're not holding it in Camden or Newark, whatever you may say about those cities. Forgive me if you're there. Or Baltimore. They're holding it in Jackson Hole, Wyoming. Nothing but the best for our bureaucrats. At any rate, that speech of hers on the 26th, talking about how the case for a rate increase has strengthened, is what we're examining. Well, what did the markets do? After that, we had ISM manufacturing, ISM services, and various other statistics, none of which pointed to a strengthening economy. And so the credit rates, the rate on the 10-year, the yield on the 10-year, the yield on the 2-year, I don't have those charts here. I couldn't get everything. I'm going to put everything up. Came off after that. That's after Fisher said something at that meeting. He said he still sees 2 rate hikes a year. Bullard said something along the lines supporting that. And then this past Friday, Rosengard from Boston said the same thing. The market started to pay attention, certainly the credit markets. Stock markets started paying attention on Friday, or at least they really got everyone's attention on Friday. And the reaction has been the credit markets are going not with the analysis of what the economy is doing. That's what they had been doing after the 26th. And that's what they've been doing with the Fed all along. The Fed has been saying one thing, and the markets have not been believing it. The credit markets, talking about in particular here. So after her speech and after the seconds from her seconds of Stanley Fisher and James Bullard, interest rates came off. The credit markets looked at the economic statistics that were coming out, and they said, wait a minute, there's no way they can raise rates. And so the rates came off. The continued rhetoric from the Fed has somewhat changed the credit market's mind, meaning 15 or so points, the last I checked, rates have gone up. Certainly, Mr. Rosengard, who, as journalists like to say, is a dove, for him to come out and say that rates probably need to rise was a switch. I believe he's a voting member as well. So that got the market's attention. Today, I think at 1 o'clock or 1:15 this afternoon, we have Lael Brainard, think that's how you pronounce her name, will be speaking. She is a Fed governor, and I don't offhand recall what bank she's from. Forgive me. If anybody knows it, they can type it in. Is speaking 1 o'clock today. She is also classified by the financial media as a dove, meaning she doesn't think that rates need to rise or hasn't in the past. So if she comes out today and makes a case for a rate increase, the stock markets are going to get hammered, and so are the credit markets, sending rates higher. So now we have, if she does, let's assume that she's going to. Although Dennis Lockhart was actually out, he's non-committal on a rate increase. He doesn't see any bubbles in the asset market. So I don't know where he's looking. I don't know how I don't know what kind of glasses he's got on that he can not see bubbles in the asset market. The equity market is a bubble. The Fed starts to convince perhaps a little bit the market that they're going to raise rates once, a 25.25% rate increase, and the market's tanked 400 points more than a month, and he doesn't think that's a bubble. Okay, he's welcome to his opinion. So let's assume that what we're seeing is a Fed campaign to convince the markets that they're wrong. Credit markets in particular, but the stock markets as well. So does the Fed, there are two questions here. Does the Fed have an economic case by its own standards whether or not to raise rates? Is there, and that would be primarily focused on inflation and employment. There's a second argument, which has a second question, which has to be addressed as well. What about everything else? Do the statistics and the sense of the rest of the economy and also global impacts warrant or at least permit a rate increase? And the last question we have to answer is, after we get those two, why is the Fed starting this question, raising this question again? Okay, so let's first look at the Fed's own criteria, which are primarily, because after all, they're a bureaucracy empowered by the government in Washington, which is ostensibly a representative of the people. Okay. Non-farm payrolls. Let's start there. Okay. Non-farm payrolls, the obsessional statistic of the markets these days, as I've said in other webinars. Fashions change. When I was trading on Wall Street, currencies for Credit Suisse, both in New York for 10 years and then in Singapore for a couple of years and in Bermuda for a couple of more years. The obsessional statistic for the markets, for the currency markets, was the trade deficit. When I got started in the early 90s, a U.S. trade deficit was a new development. And so the markets were very focused on it, very obsessional about it. And it would come out at 8:30 on a Friday afternoon, on a Friday morning, just like the non-farm payrolls do today. And the markets would often go bananas. And it was lots of fun, or at least in retrospect, it was lots of fun. In those days, the traders actually made the prices, managed the positions, and you better be in good shape to do that trade. Anyway, the market's no longer like that, so I won't reminisce anymore about it. Looking at this, non-farm payrolls of the past 20 years, there is nothing in this chart which shows acceleration. I mean, again, looking at the empirical information is where you start when you want to make an analysis. At least that's where you should start. So if we look at this, there's nothing that shows any particular acceleration. You could say that job creation is worse than it was in the late 90s, yes. Approximately what it was in the years leading up, but certainly there is no sign on this chart of a runaway labor market. Okay, what other proof do we have of this? Now the Fed can say that this is a good, considering, they can make lots of statistical, lots of excuses about why this is a good market, and it could be a problem. I don't see it, but let's take a look at another one which I had up there a second ago. Personal spending, where's my personal income? Sorry. Labor costs, where's my, here it is, sorry. Okay, my apologies. Okay, this is personal income. Again, the reason I didn't use average weekly earnings or average hourly earnings are because the statistics don't go back far enough. This is average personal income year-over-year annual increase. If, as the Fed maintains when it says that we need a rate increase, if the reason is because the economy is starting to overheat and we don't want to get behind the inflation curve, then, and what they're using that as an indicator is relatively good non-farm payrolls over the past couple of years. Of course, the quality of those non-farm payrolls is phony, and I'll tell you why. Let me show you right here, and I'll just make a brief case for this. Where's non-farm payrolls? Okay, this is non-farm payrolls. This only goes back 20 years. There is a chart that goes back much further. I didn't use it. What is not on this chart, but is very, very relevant to the numbers that we're seeing represented here. And of course, that's population. These are actual numbers. They're not percentages. So 151,000 is the seasonally adjusted. That's another whole topic, which I'm not going to get into, the validity and the reason for seasonally adjusting numbers. It's a fascinating topic. It's a little dry, but it's a very interesting topic. Anyway, this goes back 20 years. The numbers now are not quite as good as they were in the late 1990s. But what else is not true? The US population is not the same. So for these numbers to represent the same type of economic growth that was available and jobs were being produced back in the late 90s, or even in the middle part of the last decade, you would need substantially more jobs. Markets and the Fed tend to treat these numbers as absolutes. They're not, or at least they shouldn't be. Jobs represent people working. That's what the numbers represent. They represent income available to go out into the economy and buy things, thereby producing a wonderful virtuous cycle where more people get jobs, more people spend, and there are more jobs created. Ta-da. Okay? That's true. But the issue is that the numbers are not keeping up with population. Okay. Okay, so let's go back to personal income. Okay. Personal income. So if those numbers that the Fed are pointing out that it's time for a rate increase, because of they've achieved their mandates, and even if you accept the argument, which I do not, but accept the argument that non-farm payrolls are warranted, that a rate increase is warranted because non-farm payrolls are chugging along so nicely and things are about to get out of hand. Even if you accept that argument. If that were true, then what would be necessary? Then what would be happening behind the scenes? What would be happening is that employers, being unable to fill jobs, would have to start offering higher wages. Now, personal income is not the best measure of this because it also includes non-wage income. But like I said, the wage numbers don't go back far enough to give you a historical sense, so we'll deal with it. And for most people, even people, the vast majority of people in this country, even people who own stocks, the stocks are a very small percentage of their income. It's a greater percentage of their actual wealth, but it's a very small percentage of their income. Very few people live or have any substantial addition to their income from equity returns, from actual income generated, not by wealth, meaning your stock is worth more, a particular share, but it generates dividends or returns back to you. So although this is not perfect, it is an acceptable statistic for our purposes here. There's nothing, again, empirical knowledge. We're looking at statistics from the economy. There isn't anything in this chart which shows the type of acceleration in wages that logically would occur if the labor market was reaching full employment. You know, I heard this on the way in this morning on Bloomberg Surveillance, my favorite business show. If you're anywhere near where you can get that in the morning, 7 to 10, Michael McKee and Tom Keene, listen to it. It's the best thing going, probably in journalism, but certainly in financial and business journal. Nothing's even close. Anyway, I know I give them a plug every single time I've ever been on the show. That's not, sorry. There's nothing here which provides proof, indication that the economy is at full employment. I don't care what the employment statistics, which are the most ruthlessly massaged statistics there are out there, that show an economy reaching full employment. Wages do not go down when the economy reaches or gets close to full employment. It doesn't make any sense. So, the Fed's own statistic, although on the face of it, at non-farm payrolls, it seems like you can make a plausible case. I don't think you can, but you can present it that the economy, they need to raise rates because, you know, things are getting a little out of control. Certainly not the case. Certainly not here. The Fed knows this. They have spoken a number of times. Ms. Yellen certainly has, being a labor economist, basically, to start with, from Bay Ridge, actually. Same part of Brooklyn that my wife grew up in. Went to that Hendrick Hudson. Anyway, never mind about that. The school she went to was, in the old days, a rather tough school. Anyway, if I remember correctly. And someone from Brooklyn in the audience will no doubt tell me I don't know what I'm talking about, since I'm not from Brooklyn. Now, the Fed has mentioned this a number of times, and Ms. Yellen has herself, that they are disappointed, they're waiting for, they're expecting, that's their wonderful locution, they're expecting things to get better in the future. Stuff never does, but that's okay, that's what they want. At least they know and seem aware that the statistics, the wage statistics, income statistics don't really support the idea of a strengthening labor economy. Okay, let's look at these two. The other mandate, as we know, mandate, is CPI, is inflation. This is year on year, overall CPI. The Fed likes to, as we all know, I've heard 100 times, the PCE, Personal Consumption Expenditure Price Index, core, meaning food and energy out. I've always maintained that that is a nonsense measure, because if what you're really interested in measuring inflation is its impact on the economy, meaning its impact on consumers, on businesses. Does anyone here not eat? Does anyone here not drive? Does anyone know a business that doesn't utilize energy to produce its goods? Of course, all that's nonsense. So if you're trying to measure the impact of an inflation on price changes on an economy, you need to look at the overall measure. That's always been my argument. That's your argument of the ECB as well. The ECB monitors its overall price measure, not the core measure. Even the logic behind the core measure, in that, you know, price changes to energy and food are transitory, is nonsense. Be that as it may, let's take a look at both. This is CPI, 20 years, year over year. The Fed's target is 2%. The whole argument about 2% being necessary for economic growth, I believe, is nonsense. I don't think it's true. I think the logic behind it is simply that there's so much debt in the world that the only way to get rid of it is to inflate it away. But that argument aside, there's nothing in this chart which shows accelerating inflation. And if it is accelerating, it's accelerating to less than 1%. The Fed, this is the last time the CPI was at 2% was one, two, three, almost 4 years ago. Now, you know, the Fed's getting behind the curve. This is all possible, but there isn't any real sign of it in the statistics. I tried to get PPI, but PPI did not, in the statistic I could find, did not go back far enough, because I wanted to look one step deeper and see if there was any price pressure building in the underneath the CPI in the production chain, and there isn't, of course. Anyway, this is the longest chart I have. And this is the Fed's PCE core going back 30 years. And 30 years, I want to show two things by this chart. One, there has been a slight uptick, but there certainly is, you can make some sort of argument. We're about 1.6 right now, been there for a while. You can make an argument, and the Fed will do this because it needs to make statistical arguments. After all, the Fed is data dependent. It's not, but that's another story. It is if it gets the data that it wants. The Fed wants to raise rates, and I'll go into the reasons why I think that's both their position and probably a good idea. Although it's going to be costly, and I'm wondering whether they'll do it. But anyway, so they need to make an argument. You can, as I said earlier, you can make an argument from non-farm payrolls that it's accelerating. It's a weak argument because it's not backed up by secondary data, primarily income data. And here you have an argument about PCE and its acceleration. Yes, there is an upward slant from about the beginning of last year, higher. But if you look at the overall 30-year trend, it's lower. And there's nothing in that chart that shows you any breakout of that. As a matter of fact, the only argument you can make for these two statistics that a rate increase is warranted is this one. The Fed likes to talk about inflation expectations. The only inflation expectations, in my mind, that make any sense to quote are ones which come out of the credit markets. Consumer price inflation expectations are silly, because all that consumers end up expecting is what they've seen most recently. And that's a uniform projection on all consumer expectations. If you had looked at consumer expectations for inflation back in the early and mid 80s, you would see that they expected inflation to be 12%, forever, or at least in the near term. Why? Because that's what they'd experienced. So if you're looking for inflation expectations, consumer, which comes out with various surveys, is, in my mind, useless. If you look at the expectations of the credit markets, you're basically looking at the yield curve, which does not provide the types of that. So looking at this is just like the non-farm payroll number. You can make a weak case, I think, for the Fed's rate increase from the initial number. Non-farm payrolls not backed up by income data. You can make an argument for the inflation rate. Well, it is on an upslope. It could get worse. The Fed better jump ahead of it. Okay. But the Fed likes to talk about expectations as well. And the credit market expectations are nothing like this. There are no expectations near or far term for inflation as exhibited in future in bond rates on long-term securities, bonds. There's no inflation there. So again, now the Fed knows this, but again, the Fed is in the public business. They're bureaucrats. Their brief is inflation and employment. So they must make their public arguments in light of those responsibilities. So the Fed has got to make an argument, if they want to raise rates, based on its official responsibilities. As with non-farm payrolls, the secondary statistics, for my analysis, do not back up their contention that these numbers are bordering on the need for action from the Fed in raising rates. Okay. Now, so that's the Fed's argument about, or the Fed's official responsibility argument about whether or not they need to raise rates. Let's look at the economy behind it. So what we're going to do now is we're going to look at the economy, because after all, those two numbers hardly represent the economy in total or even in partial. And then we're going to look at why the Fed might still campaigning for a rate increase. And then we'll be done. Okay, so what should we look at first? We're in a consumer economy. Let's look at consumer numbers. Retail sales. Okay. Year over year. Is year over year? I believe it is. It should be. It better be. Yes, it is year over year. There you go. Year over year, right there. Again, historical sense. Does this chart depict an accelerating economy? I, for the life of me, can't see how. That is a yearly, the moving average is an annual moving average of the monthly annual numbers. Okay, so we have a real economy number, retail sales. Now, retail sales, remember, is not adjusted for prices. That means whatever the generalized inflation number here is incorporated in the retail sales. So we have 2.3%. These are very rough estimates. Retail sales most recently was 2.3%. Now, I'm not going to use, here's the CPI. Again, the total consumer package was 8%. Now, these two numbers are not comparable. Are not identical. They don't compare the same items. Nevertheless, as a generalization, the world seems to be in the mood for generalizations these days. You would subtract this from retail sales. So that would give us 1.5 retail sales, annualized increase year over year. Sorry. Retail sales. There we go. There's nothing on this chart which shows acceleration, okay? Let's move on to the next one. I'm going to go through these rather quickly since they all only show a very small portion of each argument. Labor force participation. Remember the non-farm payroll chart? This represents what's missing. Population. The amount of people participating in the labor force is at, let's see, 10, 20, 30, 40. Oh no, I'm sorry. Let's see, we go back to here. So 5, 10, 15, 20, 25, 30, 35, 40-year lows. there have been a lot of changes in the world, in the United States in particular, in the labor market and the labor force and who's participating, who's working in the last 40 years. I remember when my mother went back to work and what a topic it was for our family and for my father. This represents partial truth. And what's behind it, of course? Well, if there are fewer people working, what does that mean? Well, it means there's less income being generated. If there's less income being generated, what does that mean? Well, there's less money out there to buy things. If there's less money to buy things, what's happening? Fewer things are being made. And if fewer things are being made, there's like economic growth. And we've seen that. If we look at GDP, GDP for the past 3 quarters is measured 1%. It's been basically 2.1 or 2.2% since for the past 7 years. 60% of its historical level here in the United States since World War II. So these are statistics which are behind that. Okay, let's take a look at this one. This is another measure of personal consumption. Personal consumption. Not quite retail sales, similar type of figure. Does it show any acceleration? No, of course not. It does not. It simply doesn't. So we have labor force participation, lower retail sales, personal income, personal consumption. Okay? This is real spending. This is corrected for inflation. Not only has it been historically low, this one doesn't go back as far, which is why, but I included it anyway. Not only is it historically low, look at this period here and this period here, but what has been the most recent trend? Down. So again, economic statistics do not seem to support a benign view of the economy. This is ISM. That's a Purchasing Managers Index from the Institute for Supply Management. It's partially a sentiment number, but it's mostly a hard number. Are you planning to hire? A real figure. What do your orders look like? What does your production look like? There are also some sentiment numbers in there, but mostly it is hard numbers. This is manufacturing. Manufacturing is a big topic in this year's election. I'm not going to go any further with that one. But you can see, it has long been considered by economists a leading indicator for the overall economy. It's somewhere between 85 and 90%, or put it in reverse, somewhere between 10 and 15% of the US economy is involved in actually making things, as opposed to service. What I am doing right now is a service industry. When you're trading, that's some sort of service industry. You're not making something. And really, completely unexpectedly, at least for general economists, the economy dipped back into contraction in manufacturing. You might say that doesn't matter very much, but actually it does, because it has been a good indicator of where the overall economy is going. 50 is the level between expansion and contraction. It's an index. It's not a real number. It's a constructed number. Not something with this number indicating an economy that is about to require restraint. Services, 85% or so of the US economy. I'm not going to argue the actual numbers. Same thing. 51.4, which I believe was August, is the lowest number index for the major portion of the US economy in 6 years, right? Yeah. Yeah, more or less 1, 2, 3, 4, 5, 6. You could say 6.5 years. Not the type of situation seeming to require a Fed increase in rates. So even if you can make a weak argument, and I say weak argument because neither one of the initial statistics that you're looking at, non-farm payrolls, employment, and inflation, are backed up by secondary statistics in the same sector. Even if you can make an argument for a Fed rate increase based on statistics, remember our Fed is data dependent. Yeah, I was going to make a comment on that, but frankly, why bother? The statistics out of the rest of the economy, which we've just looked at. We've looked at ISM in the Purchasing Managers Index, one of the few actual forward-looking statistics that are pretty good. We looked at labor force participation, retail sales. Oh, here are two more. Are not the kind of statistics that in any sense support the logic that a Fed rate increase is required because the economy is overheating. Okay, this is unit labor costs. Unit labor costs are what people have to pay their employers. If they're rising, it's not particularly good. From here, from the late 60s into the 80s, unit labor costs are rising. Why were they rising? Because inflation was rising in that period. And workers demanded more money. That's why. Productivity came here, inflation was tamed, and unit labor costs have been slowly going down. They have started to rise again recently. The reason is here. Productivity. When it's rising, of course, good. This is the advent of computers pretty much in the workplace, and there's a pretty substantial rise in productivity. You could make an argument that the argument from here is the advent of social media and the internet on everybody's desktop in the office, and that's why productivity has been going down. I make that argument humorously, in case anyone's wondering. But at any rate, there has been now a trend down in productivity, up in unit labor costs. So if you have lower productivity and higher unit labor costs, this relates back to compensation. Businesses can't afford to pay anymore, and they won't pay anymore. So all of the statistics that we've looked at right now relating to the Fed's rhetoric. Let's look at one. I'm going to do one more thing here. Stay right there for a second. Don't anybody go anywhere. I just want to pull up offsite here, or off the air, the Bloomberg terminal and see what stocks are doing. Stocks are up 16? Wow. I'm really surprised at that. Okay, cool. I thought it would be lower. Okay, sorry about that. So all of the statistics that we've looked at here behind the employment and inflation numbers do not point to a U.S. economy in need of a rate increase. Now, I'm not saying that the rates shouldn't go up. I'm just saying that if you're making a case that the Fed is data dependent, the idea that governments are all technical experts who can always do the right thing is a very, very silly and dangerous argument. Because that assumes that we have, especially in the area of economics, we have the information necessary. We can always make the right decision. This is nonsense. It's simply not true. Information is imperfect, and decisions are always mediated by the assumptions that you bring to the decision. Okay. So we look at statistics from the economy. It's very, very difficult to make a strong or even a weak case. And there are many people out there saying this, that the Fed needs to raise rates. Okay. So why does the Fed want to raise rates? And I would largely support the idea that they do, although I wonder if they'll have the nerve to do it. Their rate campaign for this year was short-circuited by an equity collapse in January and February. It was also short-circuited later in the year by a couple of month collapse in non-farm payrolls. So what the Fed seems to be saying, and I think they are saying, is that we're not looking for the economy to accelerate. What we're looking for as a base case for our rate policy is that the threat of a hike doesn't tank the economy. That's, I think, what they're looking for. Why does this make sense? As a way to, they're not saying this, of course, but I think it's true. When they say data dependent, they are no longer talking about acceleration. They are speaking defensively. Can the economy tolerate a rate increase? But if you don't need a rate increase to stave off or to prevent something negative happening, why do you need to raise rates? Well, that's I think, the core of the argument here. And the logic is quite simple. There will eventually be a recession. The Fed hasn't outlawed or eliminated the business cycle. And what are they going to do to mitigate a recession if rates are at 0.5%? Now, it's not going to be any better if they're at 0.75% or even at 1%. You know, in order to get any kind of effect from a rate reduction, you need to have rates somewhere around 3%. Well, that's not going to happen anytime soon, but it's certainly not going to happen if they don't start doing something now or very soon. So the real logic behind a Fed rate increase, I think, is twofold. One, maybe threefold. Twofold. One, the longer you keep rates at this level, the more likely you run into a recession with rates way too low to do any good. Two, if you do run into a recession with rates somewhere like this, then the tools that you have, basically quantitative easing and other buying methods, are one, limited, and two, ineffective. I think the Fed has begun to realize that the idea of, actually I heard this, an idea of mine, but I'm sure it was somebody else's first. Behind all of this is the realization that the costs, the economic dislocations, the maladjustments that are incurred by zero interest rate policies are far more damaging than economists assumed. Economists, to use a metaphor I really like, assumed they were living in a Newtonian physical world, and in fact, when you get close to zero, you end up in a quantum world. The results of the same input are different. Lowering rates from 3 to 2% for the Fed funds has one impact. Lowering rates from 1 to 0 does not. It has a different impact on the economy. So the logic behind the Fed's pending and rhetoric, because as I said, to wrap up, we're at our limit here. If the Fed clearly wants to raise rates. The statistics, their statistics marginally support it. The U.S. general economic condition, and behind that, of course, the world, does not support it. The Fed still wants to raise rates. I believe the Fed needs to raise rates. They should have done it 2 years ago. Because of the distortions incurred by zero interest rates, and because of the pending, if not incipient, recession problem. But they don't have any good logic for it. I don't think that matters a whole lot. I think what we're going to see is that if the equity market, this is a campaign by the Fed. If you don't think, and I do think, that this is all coordinated, it is. It should be. And I think what the Fed is trying to do is to see, again, they tried this back in January, or they tried this back in December. Things haven't changed very much. And the markets had a very bad reaction. This is the whole topic of Fed credibility, but it's not just credibility. It is also real in the sense that there are real economic effects going forward and going backward, or looking backward. And that's why the Fed is starting this campaign again. And the logic to it, I think, is this, and this is where I'll leave everyone. What the Fed is doing, as they've done in the past, and I've written this up a number of times, they're conducting an experiment. They want to see if they can convince the markets that rates are going to go up without the markets having a major conniption. We will see. On Friday, the markets had a serious conniption, but not one that is any of any great moment yet, considering where the markets are and where the economy is. Okay, folks, so just as a final note, I believe Ms. Brennard is speaking at 1:15 today. I don't know when the text is actually released, if that's beforehand or not. Keep a watch and stay on your toes. It'll be interesting if she comes out strongly in favor of a rate increase. Okay, thank you all very much for attending. I hope it was useful, moderately entertaining, and a piece of good humor. So I wish you all well, and we'll see you next week. Take care.